As we head into the weekend, the U.S. markets are closed for trading on this Saturday, November 15th, 2025. When the closing bell rang on Friday's session, November 14th, Tesla Inc., ticker TSLA, finished the day at $404.35 per share. This marked a modest gain, up $2.36, or just 0.59%. On the surface, after a volatile week, a green close might feel like a small relief, a moment of stability for holders of Tesla stock. Many watching their Robinhood app or Fidelity mobile app might see that small green number and think the worst of the selling is over, that the stock is finding its footing. But that is the expectation. The reality is far more severe. That tiny 0.59% gain is a hollow victory, a minuscule bounce after a brutal three-day slide that saw the stock plummet 9.7%. This wasn't a dip, it was a capitulation that dragged Tesla into a place no one expected. It is now the only stock in the Magnificent Seven cohort that is negative for the year 2025. While Apple stock and Nvidia stock continue to define the market's strength, Tesla has been fundamentally disconnected from the narrative of tech dominance. Friday's trading session was a battleground, with volume surging to over 105 million shares, well above its average. The stock opened low at $386, dipped even further to $382, and then staged a $30 intraday rally to hit $412 before fading into the close. This is not the chart of a stable company. It's the chart of a story at a violent crossroads. The common belief, the narrative that has powered Tesla for a decade, is one of inevitability. The expectation is that Tesla is not a car company, it's an AI company, an energy company, a robotics company that just happens to sell cars for now. Investors believe in the long-term vision. They see the record 497,000 deliveries from the third quarter as proof of unstoppable demand. They look at their online investment platform, whether it's SoFi Invest or a traditional individual brokerage account, and they see a long-term holding. They hear about FSD, or full self-driving, and they picture a future of robo-taxis printing high-margin profits. That is the expectation. The reality, however, is that the present-day foundation of that story is showing deep and alarming cracks. Let's start with those record Q3 deliveries. The data is now clear that this was not a signal of organic demand growth. It was an artificial pull forward, a surge of customers rushing to buy before the $7,500 federal EV tax credit expired on September 30th. The consequence? Analysts are now widely forecasting a sharp delivery slump for the current fourth quarter. The demand wasn't new. It was simply borrowed from the future, and the bill is coming due. But a potential Q4 demand problem is, shockingly, not even the most alarming news from the past week. The real bombshell is the operational chaos. We've just learned that the senior managers and program leaders for the Model 3, the Model Y, and the Cybertruck have all announced their departures. This is not a minor shuffle. This is the exodus of the core leadership responsible for Tesla's entire vehicle lineup, from its cash cow Model Y to its critical Cybertruck production ramp-up. You cannot lose the institutional knowledge for every single one of your key products and expect the market to believe it's business as usual. This creates an execution risk that is impossible to quantify, but incredibly dangerous. It's a five-alarm fire in the engineering and production departments, and it happened just as the company faces its stiffest headwinds. This is the kind of development that has professional asset managers, the ones using Fidelity wealth management or complex terminals at Interactive Brokers, seriously reevaluating their risk models for the company. This isn't just about self-investing based on a feeling, it's about a tangible loss of human capital. And then there's the margin story. The Q3 earnings report was a perfect picture of this expectation versus reality conflict. The expectation, record revenue, which they delivered at $28.1 billion. The reality, to get that revenue, they had to slash prices so aggressively that their operating income collapsed by 40% year over year. Their vaunted operating margin, once the envy of the entire auto industry, has compressed to just 5.8%. This is the cost of the price war, and the war is only intensifying. In China, the world's most important EV market, the situation is even more dire. Tesla's sales of China-made vehicles are down 10% in the first 10 months of 2025. This isn't a slowdown, it's a retreat. This is happening while the Chinese domestic market is in a state of implosion, an oversupply-fueled price war so brutal that it's forcing Chinese brands like BYD to aggressively export their cheaper vehicles, which will only put more pressure on Tesla in Europe and other markets. This is no longer a story of Tesla versus legacy auto. It's Tesla fighting for its life against a wave of new, hungry, and low-cost competitors. It's no wonder that even staunch bulls like Cathie Wood's ARK investment funds have been seen trimming their Tesla stock positions. When the most vocal supporters start to quietly sell shares, retail investors should pay close attention. So let's look at what the company actually is today versus what it promises to be. Tesla's business model has always been built on a few key pillars: a direct-to-consumer sales model that cuts out dealers, a proprietary supercharger network that creates a sticky ecosystem, and the promise of high-margin software revenue from full self-driving. For years, the auto business, particularly the Model 3 and Model Y, was wildly profitable, funding the moonshot projects. That era is over. The Q3 report confirms the auto business is no longer the high-margin cash printer it once was. It's now a high-volume, low-margin business fighting in a commodity-like price war. The company is even dealing with other distractions, like a recent recall of over 10,000 of its residential Powerwall 2 energy products due to reports of overheating and fires. This is a direct hit to its Tesla energy narrative, which is supposed to be a key pillar of growth. The core investment thesis for so many has been that the car is just a computer on wheels, and the real value is the software. But what if the computer on wheels part is no longer profitable? How long can the company fund its ambitions if its primary business is breaking down? This brings us to the future, the final battlefield for bulls and bears. The expectation, the bull case, was just reinforced at the November 6th annual shareholder meeting. Shareholders overwhelmingly approved all company proposals, including a massive new 2025 CEO Performance Award. The market's interpretation is clear. Investors are still willing to make the long-term bet on the vision. They believe in the master plan. They hear Elon Musk project full FSD approval in China by the first quarter of 2026 and see a path to billions in software-as-a-service revenue. They see the FSD supervised system, now on version 14.1.7, getting tangibly better in real-world reviews, and they believe the robotaxi, or cybercab, is an inevitability. For these investors, many of whom are using long-term online investment tools like Schwab Intelligent Portfolios or Fidelity mutual funds, the current volatility is just noise. They are holding for the 10-year-plus story where Tesla becomes an AI robotics powerhouse. Now the reality, the bear case, the long-term vision is just that, long, and the road between here and there is filled with landmines. Right now, the company is facing an immediate and severe demand air pocket in Q4. It's facing a leadership crisis in its core engineering divisions, it's facing a margin collapse in its primary business, and it's facing a competitive onslaught in its most important market, China, where its sales are actively shrinking. The brutal reality is that the AI and robotaxi future must arrive before the core automotive business is permanently damaged by this competition. It's a race against time. The disconnect between the analysts' targets perfectly captures this war. Wedbush is still at $600 target, believing in the AI story. Guggenheim and Wells Fargo are down near $115 and $135, looking at the collapsing auto margins. The median analyst target is $380, which is below the current closing price, signaling that the professional community, on average, believes the stock is currently overvalued based on these new, harsh realities. This is a very difficult stock to value, which is why it's so volatile and so divisive. It's a story of two different companies, the one that exists today and the one that is promised for tomorrow. Comment below.